This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is an expert in something that you need. I don't care what business you're in or even what you're doing almost, you need to know some of these things that he's going to share with us today. And ultimately, it's relationships, right? It's the relationship management piece, but how that is leading to more deals and more capital in their business. And he just shares some great tips on how they are doing that and some actionable steps. His name is Jack Martin. He's the co-founder of 5210, an Arizona real estate investment firm focused on mobile home parks. And his real estate journey spans thousands of properties across several asset classes. Jack and his partner established 5210 with core values that align with their own Midwestern values and conservative approach. But you're going to hear so many things from him today. Yes, lives in Arizona with their 7 children, which you'll also hear a little bit also about. But I was so impressed with Jack and his focus on the relationship, but not only just with investors, but also with sellers as well, and what that has done for their business. You're going to find more deals if you just do some of these things that he mentions today. You're also going to be able to raise more money, more capital, and have better relationships with your investors. You're going to serve them better if you do some of the things, even one of the things he mentions today. Jack, welcome to the show. You have a superpower that it's relevant no matter what business you're in. I mean, it's so important that people know how to do what you know how to do. We're going to jump into that today. I want to know a little more about who Jack is, though. I know your focus is on mobile home parks. So we're going to talk about why and some of those things about that asset class specifically. And we're going to jump into your superpower that's going to help the listeners. But who's Jack? And let's hear a little bit about 5210 and who you all are as a company.
Yep. So we're one of those small boutique real estate investment firms who had the luxury or good fortune to trip into mobile home parks, which is an odd asset class to focus on. My business partner and I are both Midwestern boys. So he grew up in Indiana. His parents were school teachers, but they owned a small rental portfolio. So he kind of grew up in that business. And I grew up in a huge family in the Midwest. I was a Minnesota boy, 17 kids. So if you want, that's right. So if you want something greater than what your parents' budget can accommodate, well, then you just got to go find some work and earn it yourself. So both of us come from that kind of hardworking Midwestern culture. I grew up in real estate, everything. I was a general contractor and got into land development. And then we started buying rental homes with a couple buddies, and that grew into a couple thousand single family homes. And then I got into apartment complexes because that seemed like the obvious next step to scale. And then I tripped over this thing called mobile home parks, and here we are. So it's and in our business, I manage the incoming lead generation, so deals and dollars. And my business partner is the operations guy. So he manages staff and systems and processes and software and vertical integration and all those kind of things. And it's been a great partnership.
You went through a lot really fast right there. But I have to ask, what number in 17 are you?
I was number 4. Well,
Okay.
I always tell people I'm number 1, but keep that between us.
That's funny. No, that's awesome. I've not heard of that many kids too many times. But you scaled to, you said thousands of single family homes. I mean,
so we were actually one of the larger wholesalers in the Phoenix metro area. So we didn't own all of those homes. Well, we did for a short period of time, but we didn't build a portfolio where we owned them. We were an aggregator. So we were essentially sourcing deals for other groups that were building portfolios. We built our own portfolio in the background, but most of those assets were purchased, cleaned up, and then sold either as individual properties or in groups of properties to larger groups that were aggregating. Yeah.
And then you moved to multifamily. Then you also, now obviously the focus on mobile home parks. How long have you been focused on mobile home parks, and why? Why mobile home parks versus, scaling the multifamily side?
I love multifamily. I tripped over my first mobile home park in 2012, and it was right next door to an apartment complex that was vacant, and the city wouldn't let you bring it back online unless it had adequate parking. Right next door, there was a mobile home park that had enough land to be the parking. So my thought was, hey, let's buy this mobile home park. Let's focus on turning it into parking for this apartment. But long story short, the city was so difficult to work with that I just ended up owning a mobile home park instead. And it was small, but I learned all the lessons that, there's a lot of differences between mobile home parks and apartments, even though from the surface, it just seems like another version of multifamily. But because there's ownership, there's a lot of things that are different there. So you can't just kick out the tenants and start over. They own those homes. So because you have tenant ownership, the behavior of the resident is different. Management of the real estate is different. There's so many things that are unique and different about that. But when I got to know it and I got my arms around it, I understood the intrinsic recession resilient qualities that mobile home parks have. I was smitten. So I left what I was doing in the apartment space and I focus completely on mobile home parks today.
Speak to that just a little bit while you're talking about the recession resilient piece. Obviously, in the the economic climate that we're in right now, speak to some of the things that you see about mobile home parks that maybe you don't see in other asset classes. Why it's so recession resilient.
Yeah, so I think I could speak to two things that are current, or at least in the recent history that we can all kind of look back to because we're familiar with them. One of them is COVID. Like, how did assets perform during COVID? And the other one is this current, we're here in the late spring of 2023, and interest rates they've essentially doubled for homeowners from a individual seeking a loan for acquiring a home perspective. During COVID, because we were apartment guys, like we had quite a few relationships or friends of ours that were also in that space. And our experience in Arizona was that when the governor put a moratorium for eviction in place, a percentage of your tenants start to play the game of, I don't have to pay the rent, so I'm not going to, knowing that, hey, eventually at the end of this, I'll probably get kicked out. But in the meantime, I get to live for free. So there was that, several of our, relationships in the apartment industry were frustrated because they couldn't really do anything about it. But when we look at the mobile home park space, like this, the difference is the same percentage of our residents were seeking to play the same game. They come into the office, they say, hey, we heard that there's a moratorium and you don't have to pay the rent. And so we just educated them like, yeah, that's true. But at the end, if you don't pay your rent, the penalty of not paying your rent is forfeiture of your home. So they're like, oh yeah, we know. So it doesn't there's no economic value in skipping a $400 rent payment to put your home at risk, right? So the outcome was we collected all the rent in 2020 during COVID. So it's just another example of when things get difficult, the stability of cash flow in mobile home parks is something that is a little bit more predictable than our experience or our counterparts' experience in the same markets, in Arizona. So I know that there's other apartment guys that I've talked to that collected 98% of their rent or whatever. So I know that there are guys who've been able to be successful there, but our experience is just a little bit more predictable in the mobile home park space.
Goes back to some of that tenant ownership, like you were talking about, right?
That's right. Yeah. So I think essentially, like their mindset is different than a renter. Their mindset is that of a homeowner. So it's just a little bit different. They don't want to move, but anybody who has an opportunity to get free rent will take it if they can, right? So yeah,
that's right.
We did have a handful of tenants that had a legitimate hardship. They lost their job, or they actually got COVID, or they had a family member with COVID, and we worked out a way for them to defer rent and get back on track. Yeah. So I think there's still a human side of this that's important.
Of course.
but most of the tenants were just looking for a way to skip rent.
Yeah,
that's really what was happening there.
for sure. Well, I want us to jump into the thing that you focus on, right? The thing that you mentioned, was your superpower, which is relationships and relationship management, and what that has done for you. And I'd love to dive in there a little bit on and help the listeners and myself to learn from you in that regard, because I also believe it is so important. And it's not an easy thing, right? It is a full-time job, for sure, more than a full-time job, depending on the scale, but. Speak to what you do in that regard, relationship management, what that looks like for 5210, and what you do on a daily basis. And let's dive into how you do some of those things so well.
Yeah, it's interesting that, especially there's two sides to the relationships in my view, in a business like ours in real estate. One of those has to do with acquisitions, and the other one has to do with the raising of capital and the nurturing of capital once you've raised it. And we can speak to both of those. In any business of this type, like it's my belief that there needs to be somebody with a constant focus on this, because if there's not, the business doesn't. First of all, you lose potential for opportunity, if you're looking from the business outward, but then you also potentially lose credibility if you're looking from the outside in. So. On the acquisition side, to me, or at least in our experience, and this goes all the way back to the 2,000 homes that we acquired, with the exception to the auction environment, where there was a time when there was 50 homes trading at the auction every day. There was no relationship really required there. It was just highest bidder wins, right? But in most of the other acquisition strategies, it was a relationship with an attorney, or it was a relationship with a bird dog, or a relationship directly with the owner of the property. And so that was a very important piece. And it doesn't change when you go from single family to multifamily, from $100,000 acquisition to a $10 million acquisition. Relationship is still important. I think the discovery is that if all things are equal, meaning I'm still going to get the same price, I would rather sell my property to somebody I like than somebody I don't know. So the relationship side of it on the acquisitions is extremely important. And that's both, with the owners of the assets that are not ready to sell yet. So building a relationship with them might put you in a position where you get the first phone call when they're ready. Or brokers who do deals that are not available to the public. So it's in the mobile home park business, especially, like 90% of the transactions occur off market. So it's not, if you see something publicly listed for sale, you're only seeing 10% of the transactions that actually trade. So there's, and I don't know why that is, but that's just the way that it is. So it becomes exceptionally important in this business if you're going to have a wide funnel of deal flow, which is really important. It's important to the growth of the business. It's important to the investment capital that you have ability to source great deals so that you can pass up 99 and purchase the one. So it's a really important part of the business there. On the capital raising side, investment capital is very personal, and I think you can lose sight of that if you start to look at investment capital as a number. So when somebody is seeking to invest, there's a wide range of experience when it comes to investors. So you have the first-time investor who's never done this before, and they're recently accredited, and they're seeking to divest from the stock market, and they're looking to get into something alternative as a hedge against, the volatility. There's trust that's required there. They've never done this before. There's education that's powerful, and it's important there. And then on the other end of the spectrum, you have the professional investor. This is all they do. And they vet sponsors, and they know how to do it, and they're good at it, and they're allocating to create diversity in their portfolio. And really what they're seeking is, I want a piece of all these different asset classes, and I'm just seeking the best sponsors in the space so that I can allocate with relationships that I can lean on and trust. So when you understand all of that, the first timer and the professional both require relationship and the nurturing and the constant. And there's more relationship required after the investment than there is before. So,
Yes.
just the sales piece of it, like that's important. But what's this investment experience going to be like for the next 10 years as I'm invested with you? Like, that's a really important component.
Yeah. Give us one or two hard things that you do to manage those relationships so well, with your investors. Maybe it's the ways you follow up, or how often, or I don't know, how you get creative with just growing that relationship and keeping it going consistently.
I think without question, the most important part of this business, and this is post-investment, but you could say that those who are watching you from afar have an awareness of this. If you commit to reporting and distributing cash flow on a specific date, make sure you're on time. If you can consistently report every 90 days, we do it on a quarterly basis, and you can distribute their cash flow on the calendar as you've agreed to, that speaks volumes for you. And a lot of these investors are dipping a toe into the water, and they say, well, I like everything I hear. I love the investment thesis. I like the yields. I'm comfortable with the risk. Let's see how these guys do. Let's give them a year. Let's see how they do. And then once they see, okay, now these guys are exactly who they said they were, and they do exactly what they said they'll do. Now they're willing to drop in way more money than you thought they had. So I think without question, the most important thing is, and I believe that needs to be designed prior to you starting to buy deals. It's almost like, hey, we're going to get on the racetrack and we're going to race. And we're not thinking about tires or suspension. We just have a car. And now in the middle of the race, you can't stop and build suspension. It's too late. You're racing. So I think that you see commonly in real estate, guys are good at real estate and they're so excited about the deal that they forget to architect a very sound communication plan with calendar events and like what leads up to that calendar event. Like, how can we be certain that we're going to report on time? Like, when do the books need to be done at every single property? On what date, so that we can meet these objectives? Same thing goes for taxes. I think the greatest pain point, and particularly when you start to attract investment capital through groups or through wealth management advisors and those kind of groups, the first question they ask is, hey, when did you deliver your K-1s to your investors last year? And if it doesn't begin with March, then they're probably going to look for somebody else. So how can you architect this? This is all. This doesn't seem like it's investor relations, but this is a lot of what makes up their experience. So in my view, it's my goal to create the best investment experience that an investor could have in this asset class. That means he's going to have access to me. Accessibility is really important. So if I'm the one who worked with him as he invested, the expectation is if I have questions in the future, they still have access to me. That cannot go away. Can't just be punted down to some low-level assistant who can't answer questions. So that's really important. But the expectation of getting of having the outcome be exactly what was promised on every scope. And here's an interesting one. If things don't go as planned, how transparent are you? So everybody that has been investing long enough has experienced, I invested with this guy, he promised this, and then this didn't show up, and I couldn't hear from them, and I didn't hear a word from them. Well, what's the first thing that happens in the investor's mindset? They're worried. Now they can't sleep. That's right. So instead, if there's, let's say that you had a hiccup in the first 6 months of this asset that you didn't anticipate, and you're not going to be able to distribute until Q3 instead of, out of the gate. Well, share that with your investors. Just come right out and share it. Be transparent. I think that you'll gain more respect from being honest and transparent than you ever would from trying to pretend like nothing happened and hope they'll ignore it.
It will only bite you later.
That's right. That's
It will
right.
only bite you.
Yeah.
Yeah. It's easier just to get it out there. I agree.
I think there's a common fear of disappointing investors. But the truth is, if we're guilty of one thing, we over communicate. Nobody's gotten mad about our over communication. So
what's your frequency of communicating? And we're running low on time, but give us just maybe a quick description of what you all communicate, or what's your, what do you put in an update, for investors, and what do you make sure is in there?
Yes, we have a weekly cadence of communication by email. And when we're acquiring a property, a lot of it will have to do about the acquisition, or when we're selling a property, a lot will have to do about that. But otherwise, it's industry news. It's, hey, we just hired this new person and we're excited about this. So it's a lot of just helping them stay with their finger on the pulse of the industry that we're in and the business that we're in. On a quarterly basis, every 90 days, we use a fund administrator. So, we're not doing the accounting and the distributions and the return of capital and all of the management of capital and the compliance and regulatory things associated with that. So we have a neutral third party that does all that. It's kind of nice because it adds a layer of transparency.
That would be nice.
Yeah. But they deliver P&Ls and balance sheets and member statements, specific to the investment itself. But we deliver on the same cadence every 90 days an update on the progress of the properties, and how does that progress at the property level translate to progress on the investment level. So we deliver a more kind of look inside the business. Hey guys, here's how we're doing on these properties. Here's what it looked like when we bought it. Here's our goal. Here's where we're at. So we do that kind of an update. And then inside of that report, if there's anything that's unique, specific to tax time, or, like during COVID, we were sharing with them our COVID relief plan and all these little interesting things. But those things happen on an every 90-day basis. But we're constantly in front of our investors, so it's not overwhelming. It's just an email once a week that allows them to get a appreciation for, hey, what's new at 5210.
Yeah, no, I love that. Love that. We battle between what's too much, what's not enough, to stay in front of our investors. We're going to move to a few final questions. Jack, I would love to get your at least quick thoughts on, what do you expect to happen? It's what everybody's asking, right? What do you expect to happen in the next 6, 8, 10, 12 months? Because what I say is, people say, well, I don't have a crystal ball. Well, yeah, but we still believe something, because that affects what we do now, right? That affects, are we buying? Are we selling? What are we willing to pay? All those things because of what we believe is going to happen. And how, what do you all believe is going to happen in the next 6, 12 months? And how is that affecting, what you all are doing?
Yes, so I think that we'll continue to purchase mobile home parks because we believe that they will survive any market volatility out there, especially when mobile home parks are managed correctly. There's really not much that can shake them. So interest rates haven't shaken them. We're selling homes at a faster pace to a higher quality resident today than we were prior when interest rates were 3%. So COVID didn't shake us, so at least from that perspective, mobile home parks are kind of unique. But our view is that from an investment perspective, the greatest challenge that exists in this environment is the interest rate environment, the changes in interest rates. So at some point, from a macro perspective, and I'm a little bit of a nerd around what the Fed's up to and kind of bigger picture in this world. At some point, the impact of that aggressive interest rate move will have an impact on the economy. It'll have an impact on unemployment. And when that occurs, then the Fed will pivot to solving for that. Now, usually that means loosening monetary policy, likely interest rates will come down. So I think that this is a spot in the middle of the pendulum swing. Right now we're way on one end of the spectrum, and it will come back and it will go the other way. So if you look at history tends to repeat itself because human nature does. So I believe that you're going to see that pendulum swing again. I think potentially this current market could be where there's an opportunity to acquire assets at a discount if you can purchase them and put appropriate debt on them. So fast forward, if a deal works today at 6.5% interest rate, fast forward when you can refinance at 4%, for example, don't purchase it with the requirement of a refinance, but if that shows up, that's going to be gravy. So, and the yield will just get better. So I think that if you look at the political environment, it wouldn't surprise me that, we have an election next year and the current administration is going to want to take credit for the economy being great. So I'm sure there will be some pressure put on the Fed, help us make the economy get fired up again. So who knows? I mean, there's all these potential catalysts that could create that. But I think if the most important lesson that you can learn about real estate is to go study history. History repeats itself. So what's happened before will happen again. And it'll be a different catalyst this time. The next market top and correction will not be because of subprime debt. There will be something else that creates it. But what you can be assured is that human behavior will repeat itself. So we will have another correction. So at both the same time that we're optimistic that we feel like there's more legs left in this real estate cycle, we also have an awareness that it will come to an end at some point. So position yourself so that you can either weather that storm, and that's why we love mobile home parks, or be smart enough to recognize that when it's getting to that point, maybe you should exit some of your assets.
What are some of the most important metrics that you track? Could be personally or professionally.
There's a book out there, and this will be great for your audience. It's written by a guy named Philip J. Anderson. It's called The Secret Life of Real Estate and Banking. In my opinion, that's the best book written on market cycles that's ever been written.
Say the name again. Philip J. Anderson.
Philip J. Anderson, The Secret Lives of Real Estate and Banking. And it goes into the relationship between real estate and money. It also touches on corruption, greed, political influence, all of those things. And it goes back several centuries. And the accuracy of real estate cycles is surprising how accurate they are or how repeatable they are. If you're in real estate and you haven't read that book, that's probably the greatest gift from this podcast. It's $35 on Amazon. You got to go read that book. Yeah.
Well,
so I won't steal the narrative from that book, but I think the highlights of it is that there's a very repeatable human behavior that causes cycles to occur. So we pay attention to a handful of things, and I'll highlight a few of them. What's the price of land in a neighborhood that you know well? And I'm talking about not subdivisions, but like, an individual acre of land compared to what the peak of the cycle was last time. Every single time, the value of a piece of dirt is significantly higher than it was at the last peak. So pay attention to land. You can't pay attention to home prices because the cost of labor and materials goes up with appreciation. So the only comparable apples and apples thing is the land. The second thing I think is important to pay attention to is condo conversions. When it no longer makes sense to purchase apartments for investment, and you see rampant apartments being purchased and converted to condos because it's the only way to make a profit, start sharpening your for sale sign pencil. You should probably sell into that heat. So there's a few other things that book will share, but those are some of the things that we pay attention to on a regular basis.
What are some daily habits that you are disciplined about that have produced the highest return for you?
Highest return has changed. I'll be 50 this year. In 10 years ago, highest return to me was about money. Today, highest return to me is about joy. Joy comes from the relationships in your life. It includes the relationships with investors and coworkers and the residents that you serve, but it also includes your marriage and your children and your friendships. So the daily practices that have given me the highest return of joy is my daily lap with the Lord. It has profoundly changed my view of work. And I realized I used to think that everything great that came into my life was because of me. Good job, Jack. You did a great job. And then I've learned that everything that's good that's come into my life is because of things that have been given to me. And so I live a life with more gratitude. It allows me to see miracles, even small ones, every day, and little sips of joy all day long. It's you don't need to go on a vacation to get that every day. You can get it every day.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.